So lickety split, let's see how fast it should actually take you to do this. So we're going to go equals this cash value, and we're going to divide it by total assets, and we're going to put a $ in front of that, right? And we're going to multiply by 100, and that's what we want. And I'm going to copy that all the way down right to the end of the balance sheet, and I'm going to copy it over. Then I'm going to get rid of all of these zeros. I'm actually going to do this. Get rid of these zeros and here, and we don't need it here, and we don't need these here or here, and this one doesn't really make any sense either, quite frankly, but we'll leave it. And this one, and then we'll copy those to the right. Actually, we don't have to do that yet. We're going to go now, income statement. It's every number divided by total gross revenue. So we'll put a $ in front of that row because we don't want it to change, times 100, and we're going to copy that down all the way to the end of the balance sheet, or sorry, income statement, and we're going to get rid of our zeros, just like this. There's the other one, and then I'm going to grab every one of these numbers, and because copying changes the cell references, when I copy to the right, it's going to do exactly the same thing, but in the respective columns, and now I'm finished. The only thing left is to help my eyeballs. I'm just going to take all of these cells, and I'm going to use this button right here. This paintbrush is paint format, and I click that to copy the format, and I'm going to paste it at the top left of the range I want to have the same format as what I copied. And there you go. Done. That's how hard the calculation should be, right? All of these all of them, they're all percentages, right? And suddenly things start to jump out really quick, right? Which we'll come back to once we finish these numbers. So I'm not going to spend a lot of time on these because they should be review. But we want to do them for every year, but we're not going to calculate them at 3 times each, right? They are different formulas, each of them, so we do have to calculate them separate. Current is current, and now you're also again seeing why it's handy to have a classified balance sheet. We don't need to figure out what total current assets are, right? Current ratio is current assets. We have that total now. Divided by current liabilities, again, we have that total now. Much easier. That's your number. Once again, if I copy it across, it'll give me the current ratio for each year. Quick ratio is those items listed above supplies or inventory, which is just these two, divided by, again, the same thing, current liabilities, this one, right? Accounts receivable turnover in days is 365 days divided by the turnover. And the turnover is net sales on credit, and your additional information here says that all fees to clients are billed, all fees from clients, it should say, are billed and paid at a later date. So all sales, all revenue is on credit. So we're going to say net credit sales, which is all revenue, right? So this, I'm going to divide that by average accounts receivable, which means we have to take this accounts receivable and we have to add it to this accounts receivable from the year before. And we have to divide that number by 2. And that's going to mess up bed mass. So let's just do this, I think, there. So our denominator is calculated first. We put it in brackets. That should do the trick. That looks about right. 44 days. Then debt ratio is simply total liabilities. So it's going to be current plus long-term. So there's no total. There's just total current and total long-term. And we divide that number by total assets. That's the debt ratio, except that one's usually a percent, so we should multiply by 100. Last one, or 2 I should say, is return on sales. That's actually this number, this common size number, right? Because you take total profit, and you divide it by total revenue, right? And we get this. We should get the same number. So that's a percent also. So we should multiply this by 100, and we get 12.9%. Same thing, right? Because common size numbers is a percent, and so is this. Return on equity. This has an average value in it again, remember? So it's net income divided by average equity. And so that's beginning equity. So this year's ending divided by last year's ending, or beginning for this year, because this is the same number, right? This and this. So last year's ending is the same as this year's beginning. So we're going to take beginning add it to ending, and then again, we're going to divide by 2, and that will give us, and multiply it by 100, because again, it's a percent, and that'll give us 34.2% as our return on equity. And again, because all of these are relative, when you copy them to the right, they adjust. We just need to drag to the right, and we have all of our ratios for all 3 years. Copy format for our eyeballs, and our numbers are done. Now, our numbers being done, however, doesn't mean we are. We still have most of the work yet to do. And that's what we really need to talk about in this lesson, sort of in this take-up. We have to look at each line and spot what trend is there. And then your next step in financial analysis is trying to hypothesize the reason that could be causing this. So, what you would quickly do for yourself as you were analyzing a company is you put some dot shots. So for example, when you're looking at cash, so cash relative to total assets, remember, this is the oldest year and this is the most recent. Well, the cash went up and then it fell again. So there's not much you can say about that except maybe inconsistent. That's about it. Is there any really horrible trend? No, it's high. That's a huge amount of cash. In fact, it might be too high. You could say that, right? Inconsistent, probably too high. And you're going to see that elsewhere too, right? In your current ratio. You have this enormous current ratio where 2 is ideal. So you started out normal and now it's just ridiculous. In 2018, a 10 for a current ratio and an almost 10 and a 9 for the quick ratio means you probably have cash that's idle, and you certainly have huge amounts. Right, if your total assets are 9.6 million, because notice how everything are in thousands of Canadian dollars. So these are in thousands. So that 21 there is $21,000. So you got 2.1 million in cash and 9. It's like almost it's 22% of all your asset value is in cash, cold hard cash, probably in a checking account. Next, account receivable. This is a problem. See, this is the beauty of common size values right here. You can see accounts receivable is going up, but guess what? So are the company's assets. It's probably growing. Well, it didn't go up this year. It fell a bit, right? But if you look, the revenues are going up and then up again. Cash is going up and then up. Assets are going up. You would expect account receivable to go up too. The question is it going up too fast? And this tells you, yes, it is. Right? If you're growing, if your accounts receivable in 2016 was about 17% of your asset value and you grow, you would expect accounts receivable to grow. But it should stay around 17%. It's doubled. That's a problem. You have an accounts receivable collection problem. And what else measures solvency risk due to your ability to collect debt, right? Collect money from your customers. Well, that's accounts receivable turnover. Take a look. It started at about 11 days. You didn't give people credit time at all. Then you extended credit to about, the full duration of the term you usually give them. And now people are taking an extra half month longer than the month they're supposed to get. So you've really slowed down on collecting. Or you've started taking on clients that maybe shouldn't, right? Because this is a law firm. So you've got a problem in collections. It's growing. Right? And it's consistently growing each year. That's an issue. And you probably wouldn't have spotted that just by looking at those numbers. What else we got? We got supplies. Supplies are all over the place. But, that's probably not too high. It's not that much. It's a law firm. They got to have lots of stuff on hand. So those two are, if there's nothing to say, there's nothing to say. Next, land has stayed consistent. So they didn't buy any more land and get rid of any land, and the buildings stay the same too. So wherever they run the business, that stayed the same. Obviously, as you grow, your assets grow or your cash grows, these percentages will fall, and they did. But that's not necessarily bad, right? The building where you work is the building where you work. Equipment has been rising though, but again, the business has been growing. The question is, has it been rising as a percentage of total assets? Well, first it fell and then it rose a bit. I don't see anything horrific in that trend. Just a bit of fluctuation, which happens when companies grow. So I didn't see anything really negative or positive on that realm. Now that we're at total assets, notice you can't spot growth in the business or the size of the business from this, right? Because remember, common size values are divided by total assets. So total assets will always be divided by itself and give you 100%. So the conclusion there, and this is important, when you do full financial analysis with common size values and your ratios, you still need the original raw data, the original values, because you won't be able to spot any change in total assets from your common size numbers. And even more important, you will not be able to spot the growth of your business in terms of sales, right, from these numbers, because total revenue is always divided by itself. This company has grown revenue, which means it's a growth business. That's a really important thing to know when you do analysis. But it will never show up in your return on sales, right? That doesn't tell you whether revenue is growing, just profit relative to sales, gross sales, right? It just tells you how profitable you are. It doesn't tell you whether your most important item, revenue growth, because that generates profit. You got to have revenue to have profit, right? Revenue growth is one of the most important things for business prosperity and longevity. So you can't tell that from common size numbers. So you still need these values, these original values for some things like that. So moving on, accounts payable, falling as a percentage of total assets. So that's actually good, right? That's less risk from short-term debt. So all your short-term debt is falling, right? On the whole, and each individual component of it is also falling on the whole. So that's all good. So falling trend, right? And it's all falling for each component. And there isn't much to say there. It's just falling. That's a good thing. However, if this also means you're paying your debts quicker and quicker and quicker, probably. Meanwhile, remember, your accounts receivable turnover is you're collecting your money slower and slower, and yet you seem to be having less and less accounts payable. So that might be out of balance. If people are paying you slower, you might want to try to pay your creditors a bit slower if you can. Long-term debt has stayed kind of the same, but it's actually been falling, right? From 700 to 650 to 600 million. And as a percentage of total assets, it's also been falling, which means we should see, and we do, the debt ratio fall from 40%, getting close to being high, to really quite low risk, which is great. There's nothing to analyze in your beginning equity because all of these statements are year end. So you really only want to look at these three numbers. You almost don't need these at all, right? You want to look at what is profit relative to total assets. More importantly, what are your drawings compared to your total assets? How big are they? And you almost want to look at the actual numbers, right? If you're pulling out $2.5 million of cash in the most recent year, how much cash do you have sitting around? Well, it looks comfortable enough. But you do want to watch the drawings. Make sure they don't kill all the cash, because a business could still be insolvent just because an owner took out too much cash too fast. So when you start to talk about profitability and efficiency, really common size analysis is where it's really at, because you can see which of your costs are increasing too quickly or are falling even, right? So you look at advertising as a percentage of total revenue has been falling, which could be good because obviously you're spending less on it relatively speaking, but it might mean you're going to have trouble growing business revenue if you aren't advertising enough, right? So is advertising enough, right? Because it's falling as a percentage of total revenue. Delivery and postage, rising. Why is this rising so much, right? Relatively speaking, this is almost 3 times. Why is that so high, right? Because look at total revenue has gone up from 17 to 20 million. Again, you can't see anything with this number, but if you were to take, this is all about percentage change. If you were to take current value and divide it by the starting value over the 3 years, and we don't have enough decimal places, but if we did, we'd see that's 120%, right? If we multiplied that by 100, that's about 120%. So revenue's grown by 20%, but our postage has tripled, relatively speaking. Why? This cost looks like it hasn't been controlled carefully. We have no idea why postage has gone up so much. It could be just the types of clients. We could have clients that are on the other side of the country. When you have to send a lot of legal correspondence back and forth, Who knows? Change careers, whatever. You'd have to look into it. But then this one, also big growth in income tax. But as you get more profitable, that can happen. But you might want to look into that too. Next, this is pretty small, no biggie. It's actually falling, and it should be falling relative to total revenue because our debt is falling relative to total assets, right? We're paying off our debt, yet we're growing our business. Remember, our total debt, the one that you pay interest on, has been falling from 1.6 million to 1.3 million while we've been growing assets, and our revenue's been growing too. So we would expect interest to fall as we pay off that debt. Property tax is falling. I'm not sure why we're suddenly getting out of so much property tax, but that's good news. Repairs has fallen, but it's not crashing. It's kind of consistent. That's normal. Here's the big one, right? This is almost the only thing that matters. This one is kind of constant. It's gone up a little bit. Utilities have gone up wherever we're located, but they're not killing us. It's the salaries. When I look at this, I see a picture. And the picture is this business from about 16 million to about 17.5 million in total legal sales. Well, actually, in total revenue, 17.5, and then 20 million. So a big leap here. They're trying to grow this business, and it looks like they've grown it enough that they can't grow it anymore with the people they have because there's a big jump in salaries. They clearly either gave people raises, gave huge bonuses, or they needed to hire more staff to grow more because there's this big leap. It's almost like there was a whole bunch of overtime and then you couldn't hack it anymore. We needed to hire more people, and that required an outlay that was sort of disproportionate with the revenue that was going to come in right away. So maybe next year revenue will start growing quickly again, but it's almost like they needed to hire either really expensive people, so really good lawyers, or they needed to hire some legal clerks or something. But salaries expense has really jumped here. And it's either really bad management in terms of managing payouts, or maybe somebody got unionized and demanded more money. It's probably because they're trying to grow revenue and they've had to grow sales. Or they grew it expecting to grow revenue even more and they didn't. And that's a huge dump. This is the primary reason, other than maybe postage and a couple of the other ones. But really, it's this one. It's salaries that has resulted in this. The decrease in profitability from 20%. And that actually went up. 2017, 31%. So this is 31% of total revenue. Very highly profitable. But then it's crashed down to 32%. And again, it's because of these salaries. So you could write in these points that you spot, hypothesize the reasons, and then when you're done, you kind of have to synthesize it all together. And again, remember, you got two broad categories: position and financial performance. And you incorporate all these individual items and issues that you're finding when you do the common size analysis into those categories, along with the specific ratios as well. Right? So as I went through some of these, I tied them into the financial ratios we already know. So we saw that cash becoming a huge percentage of total assets at the top, right? Going from 17 up to 30 or 20% of total asset value. And we said, well, that's going to show up in our quick ratio and our current ratio. And it did. And we saw receivables growing much more quickly than total assets. And that showed up again in our accounts receivable turnover, right? Debt was falling while assets were rising. We see that also in our debt ratio falling, right? So it's almost like these kind of give you a picture of what's happening, of the key important things you want to monitor, and then you can go to these common size values to get really specific reasons as to why. All that's left is to draw some final conclusions and sort of wrap it all up. And before I wrap it all up, I will point out one small boo-boo. Sorry, right here. That's it. This can't be done. Right? So return on equity, remember, has an average value. So we look up here, we see it's beginning equity or last year's equity and this year's ending equity. Right? You got to find the average of those two. So you got it for this one. But you have to do something similar with, say, accounts receivable turnover. Right? In 2017, There's this year's, there's last year's. But guess what? If I copy that over, if I copy that over, here's total revenue. Here's this year's accounts receivable turnover, and the other one was there. Well, I don't have one for that previous year. So unless you have both values, any ratio that has an average number in it, and those are this one, so accounts receivable turnover, they are inventory turnover, and they are return on equity. You can't do them unless you have two numbers to come up with those average values for. So this one can't be done.